we have to wait. I wouldn't buy it just yet. I'd wait probably at least a couple of months, and we'll see what happens. And the charts that I'm looking at on oil and natural gas are totally different from David's charts. He is looking at ETFs. I'm actually looking at the futures themselves. And the ETFs are like, there are specific issues to the ETFs that are causing the price changes that have nothing to do with the futures. So this is the actual charts that you should be looking at. Natural gas has been dead in the water for quite a long time. This is the bullish period, September, October, November into next March sometime. So it's not really going up a lot. And fracking increased the supply tremendously in the U.S. and the natural gas markets are regional. The U.S. has a market, Europe has a market, Asia has a market. It's almost impossible to ship natural gas by ship. You can do it, it's really expensive. So you need a pipeline. And your market is wherever your pipeline is. Okay, that's it. The Middle East does not have a developed pipeline system because of politics. It could have had one decades ago, and it produces lots of natural gas, but that keeps it from moving around. So this is sort of bearish. I wouldn't do anything with it right now. Alternative energy, this is very weird. This is election day. This is actually rallied pretty much since election day. Now, Trump is not pro-alternative energy. There's no pro-alternative energy policies. And the Obama administration was very pro-alternative energy. So he gets elected and it rallies, which doesn't make any sense at all. And actually went down during Obama's administration, most of the time. So, this is completely illogical, but it's happening. So you don't ask questions. You say, well, okay, it's going up, I'll buy it. And this is actually a pretty bullish-looking chart. And this is above 50, this is above 0. And this black line moving between these two is actually a buy signal also.
Or maybe they're working on something in the background. He's going to introduce something in a few years that's natural gas, friendly.
No, this is like wind, solar.
So maybe he's
tidal.
he's got an underground business that he's going to introduce maybe soon.
His hotels, all his hotels.
Something like that.
They're all going to run on solar.
I think it's the market speaking that there's so much wind power and so much solar. Like in the movie that Al Gore made, he showed the Chile is going to tenfold or 20-fold the amount of solar that they're been producing last year. They're going to go exponential on it. So I think it's the market.
They have a lot of sun, so.
Like the global market?
They have no oil, so. Yeah, but you can't ship solar. Uranium is dead in the water. Maybe it's super cheap. David was correct about this. And the production cost has frequently been estimated around $40. So it actually looks like it's selling for less than production cost, which is very, very cheap. You can't maintain that forever. So, but this chart is generally totally bearish. So I wouldn't get too excited and run out of money. These are uranium stocks. They look a little more bullish, actually. But they're not exciting either. Stocks tend to move before the commodity, remember that. So if you want to see if the commodity is moving, you look at stocks. Now that's not happening with gold, interesting. This is gold. Notice here's the high last year, here's the high this year. It breaks above that, it has a breakout. You have the yellow line above the red line above the blue line. That yellow crossing the red is a first buy signal. And if the blue line crosses the red, then you have a bullish pattern, a long-term bullish pattern. So it's trying to do that. So let's see if that price breaks out. This is above 50, which is good. This is above 0, which is good. This is a buy signal right here. And these are weekly charts. All these charts are weekly, which are longer-term charts. So any signal on them is more significant than a daily chart. That's what's significant. And that's a out-and-out buy signal. So this is positioning for, maybe a 6-month, 1 year, 18-month run. And it's not quite there, but it's almost there. So GDX, these are big gold miners. They're not quite as bullish. That yellow line still needs to cross the red line. Hasn't done that yet. They had a big collapse in the election. Why Trump would be bad for gold miners, I don't know. Not opposed to mining. But this is above 50, which is good. This is just above 0. And you need this black line to actually cross this red line, which is not happening. So this needs, wait like another month to see what this chart looks like. Silver, if gold has a breakout, silver will follow, and it might follow 2 months later or 3 months later. Gold tends to lead and silver tends to follow. So you see gold starting to do well and silver sitting there, you have an opportunity to buy silver and make money. You know, and silver tends to move twice as far as gold in both directions, twice as far up and twice as far down. So you can lose twice as much too. So you should put a stop under your purchase to make sure it starts falling. If things didn't work out, you would get out quickly. But so this is still very flat and hasn't gone anywhere, whereas gold is going up. So watch the two very carefully. And this is going above 50, which is good. This is still above 0. It's right at 0. It's trying to move above. This is trendless right here. So like watch these two commodities. Platinum and palladium are used in automobiles, and they have their own peculiarities. They make it very different from gold and silver. They're only produced in South Africa and Russia, and one of those countries has some supply issue. They can skyrocket just because of that supply issue. And then they fall right back down. So in fact, in my books, where I trace the history of commodity prices, palladium peaked in like 1999 or something, and other commodities peaked around 1980. You know, it was totally off cycle from all other commodities. So palladium in particular is very weird. So this platinum is going sideways. You've got the first sort of a hint of a buy signal right here. This is trendless. So you can watch this. I don't want to buy it. Palladium, though, look at the difference between the two. This is like sort of sideways, going no place. And this is that perfect parallel bullish pattern. The yellow line's above the blue line, above the red line in parallel. And this is above 50, this is above 0. This is the buy signal, the blue line's above the red, the black line is green. So these are like related metals. They actually have similar chemical structures. They're used for like almost the same thing. And one is a perfect bullish pattern, and one is like trendless and lifeless. And they're both made in the same country, mined in the same countries. So that's that. Treasury bills, where we see the peak happened in December. Remember, the dollar peaked in January. You're going to see interest rate peaks happen right around the dollar peaking. This is interest rates bonds. It's not the price of bonds. They're the opposite. Remember that. And as it's going down, and David had it going down too. The 10-year treasury, it's going down also. Real bearish. This is the 10-year UK bond, and it's like just above 1%. This is 1% here. And the bottom was last year in July, August. This started rallying after the election. This is sort of bearish. It's not super bearish looking, it's a little bearish looking. But 1%, our interest rates, the 10-year at 22 is 2.2%, and it's 1% in England for a 10-year. And in Germany, it's like 0.4%. And you see the bottom this year was like slow minus 0.1. It's negative. Germany had negative rates for a while, and so did Japan. In fact, 10 countries in Europe had some form of negative bond rates. Still, we almost done. My throat's running out. So here's a Japanese 10-year bond. It's at 0, just above 0 right now. And it was this year. It was like minus 0.1. I think it was about minus 0.3 last year. So this is also bearish. This is also going down. It looks like it's about to fall below 0 again. This is a 10-year bond. So you buy it, you wait 10 years, and then you get the exact same amount of money you put in 10 years ago. Not exactly good enough. This is our other check on the market, which we keep talking about. These are high yield bonds, junk bonds. It's when this starts to go down, that means the stock market is likely in trouble. So notice it's held up, it's not going down, nothing bad happened. Notice this is election day, it started falling apart, or the week of election. But then it shot right back up. If it had kept going down, the market would have followed. So this is your canary in the coal mine. When this falls apart, you look at stocks about to fall apart. Then you buy those options and short them on. Watch this, you put this. So then we're almost done. We took out, we were showing coffee, cotton, sugar. They're all dead in the water. You should have sold them last spring. They were having rallies, but they're now being replaced by base metals. I forgot to put lumber on. I was going to do that. Base metals had the big rally. And this is an ETF.